So today, we're going to unpack a massive story of globalization. We're going to look at what actually happened when India, a nation whose economy practically beats to the rhythm of its farms, decided to open its agricultural floodgates by joining the World Trade Organization. That's the global group that basically sets the rules for how countries trade with each other. Okay, let's dive right in. Yeah, this is the big question, right? What happens? Well, it turns out it's a story of absolutely explosive growth, some really unexpected reversals, and a few hidden costs that ended up reshaping the lives of hundreds of millions of people. Now, to really get what's at stake here, you've got to understand just how important farming is to India. I mean, for decades, it has employed more than half of the entire country's population. This is not just another industry. It's the very bedrock of the economy. It's a way of life. So here's our game plan. First, we'll look at the turning point, that big moment. Then we'll explore the era before the WTO, and then, of course, the era after. We're going to put the numbers head to head, analyze the hidden costs of all that growth, and finally, we'll ask the big question. Was it all worth it? All right, let's set the stage, because really, everything changes with one single decision. You have to think of our story in two distinct parts. First, there's the period from 1975 to 1994, which we'll just call the pre-WTO era. And then there's the second part, from 1995 to 2015, the post-WTO era. That year, 1995, that's the hinge on which this entire story swings. Okay, so let's hop in the time machine for a second. What did India's agricultural trade actually look like before this whole global agreement kicked in? Well, if you had to sum up this period in just a couple words, they'd be stable and shrinking. I mean, sure, India was trading, but its slice of the global agricultural pie was actually getting smaller. Both its share of what it sold to the world and what it bought from the world were trending down. Things were predictable, for sure, but they weren't exactly booming. And to put a number on that, exports were growing at just under 3% a year. That's not a boom. That's a slow, steady crawl. But now, check this out. We're looking at a negative number here. India was actually reducing its agricultural imports over time. Exports were slowly growing, while imports were shrinking. Now hang on to that thought because it's going to be really important in a minute. And then 1995 happened. India joins the WTO and it commits to much more open trade with the rest of the world. And the floodgates, well, they didn't just open, they blew right off their hinges. Whoa, just look at that jump. The export growth rate absolutely explodes, from under 3% all the way up to over 12%. That's more than a four-fold increase. All of a sudden, Indian agricultural products are just flying off the shelves all over the globe. But, and this is the big twist in the story, imports grew even faster. They went from a negative growth rate to a staggering 13% increase year after year. The very same country that was importing less and less was now buying agricultural goods from the world at a breakneck pace. So let's do a direct head-to-head comparison. When you see the numbers from these two eras right next to each other, the sheer scale of this transformation is, well, it's just undeniable. Just look at the raw numbers here. The average annual exports leaped from about $2.4 billion to over $15 billion. Imports jumped from under $1.5 billion to almost $9 billion. But it's those growth rates down at the bottom, that's where the real story is. So back in the pre-WTO days, the story was pretty straightforward, right? Export growth was outpacing import growth. India was, in a way, kind of winning that trade growth race. But then, after joining the WTO, the whole thing flips on its head. Yeah, both grew incredibly fast, but for the first time, import growth actually edged out export growth. It's a tiny difference in numbers, but it's a hugely significant reversal. Why does that matter? It tells us the picture is a lot more complex than just simple booming growth. And that brings us to the price of all this growth. Because all that new money and all that new trade, well, it didn't come alone. It brought a very dangerous new partner with it: instability. So what do we even mean by instability? Well, it's just a measure of how much things swing up and down. Think of it like the difference between a calm, predictable river and a raging, chaotic one. For a farmer, predictability is everything. Knowing what prices might look like next year is absolutely vital for planning. And this chart, wow, this chart shows you exactly what happened to that calm river. The instability of agricultural exports just skyrocketed. It's over 4 times higher than it used to be. The market basically became a roller coaster. Sure, the highs were higher, but the lows were lower, and the whole ride was just far more unpredictable for millions of farmers. So, when we put all the pieces together, what does the story really tell us? It shows that for Indian agriculture, joining the WTO was a true double-edged sword. So let's just quickly recap the main points. There's no doubt about it, the WTO era unleashed a massive trade boom and really put Indian agriculture on the global map. But it was a complex boom. The rate of imports overtook exports, and the entire system became dramatically more volatile, which introduced a whole new level of risk for everyone involved. And all of this leaves us with a really fundamental question, not just for policymakers, but for the future of the country. As India moves forward, what should the priority be? Is it just about maximizing the total size and value of trade? Or is it about creating a more stable, more predictable system for the farmers who really are the backbone of the nation? The answer is anything but simple, but the choice they make will define the next chapter for India's farms.